Just when you think you've got a handle on the global economic winds, they suddenly whip around, don't they?
They certainly do. Things change fast.
We've seen some really significant shifts lately. So today, we're diving deep into a report that tries to unpack exactly that. It's called The Changing World of Global Trade and Tariffs, an update, dated May 23rd, 2025.
Right, a very timely piece.
And our mission really is to cut through all the market chatter and, truly understand the implications. We're looking at tariff changes, the US-China trade truce, that India-UK FTA, and also the US plans for prescription drug prices.
Yeah, quite a bit to cover there.
So get ready, because here's where we start trying to connect those dots.
Well, what's fascinating, as you said, is how these seemingly separate events are actually interconnected. They're pieces of a much larger global economic puzzle. This report really highlights how quickly things can change based on policy, based on negotiations. And it really underscores those underlying tensions that, well, they continue to shape how countries do business with each other.
Okay, let's start with that initial jolt then. Back on April 2nd, 2025, that U.S. tariff bombshell.
Yes.
A blanket 10% import duty across the board, and then those potentially massive reciprocal tariffs aimed at China, going up to, what, 145%?
That's right, 145%. And the report details a pretty significant market reaction, as you'd expect.
I bet. What did we see?
Well, equity markets took a sharp downward turn. And this wasn't just like a knee-jerk thing. It signaled a real reassessment of earnings for companies dealing with U.S. imports. Their costs just shot up.
Right.
We also saw commodity prices ease back a bit, probably reflecting worries about, lower demand overall. And there's a clear flight to safety, increased risk aversion.
And the big worry then was a U.S. stagflation, that nasty mix of slow growth and high inflation.
Exactly. That was the specter haunting the markets at that point. It's a really tough economic corner to be in.
And then came a bit of a breather, right? That 90-day pause on the really steep reciprocal tariffs for China, though the base 10% stayed.
Correct. The 10% universal tariff remained, but the specific, much higher China tariffs were put on hold for 90 days. It definitely felt like a bit of market whiplash.
So did things calm down?
Well, it was more of an adjustment period. As the report points out, that suspension did bring some short-term stability back. Markets paused their freefall.
But businesses were still nervous.
Oh, absolutely. The underlying caution didn't just evaporate. Big decisions about capital investment, redesigning entire supply chains, those weren't suddenly reversed. It was very much a let's wait and see kind of attitude.
Which leads us right into the U.S.-China tariff truce itself. Feels like a step back from the brink, maybe?
Somewhat, yes.
U.S. reducing those China tariffs from that huge 145% down to 30%, and China responding, lowering theirs from 125% down to 10%.
Correct on the numbers. But, and this is key, the report makes it very clear this is a 90-day negotiation window. It's not normalization.
Okay, so just breathing room for talks.
Exactly. It's framed as an opportunity for dialogue, for trying to find some common ground. But, the deliberate exclusion of strategic sectors, that speaks volumes.
Which sectors were those again?
Things like automobiles, steel, aluminum, pharmaceuticals. They're explicitly not part of these tariff cuts.
So that suggests what? Continued protectionism in key areas?
It strongly suggests that, yes, both sides see these areas as critical for national interests, so they're keeping those protective walls up for now.
What I found interesting was the U.S. also easing that de minimis threshold. Could you quickly explain that?
Sure. So de minimis is basically the value limit for importing goods below which no tariffs or minimal duties are collected. It's like a duty-free allowance for small packages.
Okay, so relaxing it means more low-value stuff that's in tariff-free. The report mentions Shein and Temu specifically.
Exactly. More packages from places like Shein and Temu can now enter the U.S. without hitting those tariff walls. So, yeah, it's likely some temporary relief for consumers buying those kinds of goods and for the retailers themselves.
A sort of targeted measure to ease consumer pain a bit.
It seems like a nuanced tactic, perhaps aimed at softening the blow of the broader tariffs on everyday spending.
And at the same time, China lifted its ban on Boeing aircraft deliveries.
Yes, and that's quite significant, too. It signals a potential willingness to get back to trading in those high-value industrial goods, a positive sign, at least for those specific industries.
The market certainly seemed to like it all. Global stocks rallied, didn't they?
They did. There was a definite positive reaction, some easing of those immediate recession fears. But, and the report really stresses this, caution is still advised.
Because the underlying issues haven't gone away.
Precisely. That fundamental strategic rivalry between the U.S. and China, it's still very much there. This truce is positive, but the next 90 days are critical. We'll see if it leads to something more stable or if it's just, well, a temporary pause in a much bigger competition.
Okay, right. So let's pivot now. Let's go to the other side of the globe. The India-UK Free Trade Agreement, signed May 6th, 2025. This sounds like a pretty big deal.
Oh, absolutely. As the report highlights, it really is a landmark agreement. It has the potential to significantly reshape trade dynamics between India and the UK and unlock quite a bit of growth.
Growth like any numbers.
Yeah, they project bilateral trade could jump from about $23 billion in 2024 to around $34 billion by 2040. That's a substantial deepening of the economic ties.
Wow. And a huge win for Indian exporters, right? 99% of exports to the UK now getting zero duty access.
That's a major, major benefit for Indian businesses. It removes a significant barrier.
And the report calls out specific sectors likely to gain: textiles, engineering goods, auto parts, chemicals, even marine products, footwear, toys. That's quite a range.
It is a broad range, and it lines up well with India's current big exports to the UK, which are mainly textiles and electronic goods. So this FTA gives those key sectors a real boost.
What about the other way? What does India import from the UK?
Leading imports currently are silver and machinery, so we might see some shifts there too. And another crucial element is the easier movement for professionals, business visitors, investors.
Ah, boosting service exports.
Exactly. It should strengthen service exports and just generally foster more collaboration between the two economies.
But like any trade deal, there must be some potential downsides or challenges mentioned.
Of course, the report does mention potential increased pressure on certain domestic industries in India. Liquor is one example cited because of the easier import tariffs now.
Right, that's the nature of these deals. Creates opportunities, but also more competition domestically.
Absolutely. Take whiskey and gin from the UK. Tariffs are dropping from a huge 150% down to 40%. Automobiles from 100% down to 10%.
Wow, big drops.
Yeah. So Indian consumers might see lower prices and more choice, but domestic producers in those areas, well, they'll need to adapt to that increased competition.
And there was something about Social Security contributions for Indian professionals in the UK, a 3-year exemption?
Yes, that's quite a specific and significant benefit. It applies to Indian professionals working temporarily in the UK.
Who does that mainly help?
The report suggests over 60,000 employees could benefit, particularly in the IT sector, which is a huge service export for India. It basically lowers labor costs for UK companies hiring them and makes Indian IT services even more competitive there. It's a substantial perk.
Okay, got it. So finally, let's turn our attention back to the U.S. Those plans for reducing prescription drug prices announced May 12th. This keeps coming up, doesn't it?
It is indeed. The president planning to sign executive orders aiming for a dramatic 30–80% price reduction is a very significant move.
And the core idea is pegging U.S. prices to the lowest prices paid elsewhere, that MFN model.
Exactly. The most favored nation, or MFN approach. It's designed to tackle the fact that U.S. prescription drugs are often, way more expensive, 5 to 10 times more, the report notes, than in comparable developed countries.
Right. And applying MFN, which is usually about non-discriminatory trade tariffs, to drug pricing is unusual.
It's a significant departure from the norm in the pharmaceutical sector, yes.
And this policy isn't entirely new, is it? The report mentions it was proposed before.
That's right. It has a bit of history. First proposed back in November 2020, I believe. But it faced legal challenges, got delayed, and was eventually rescinded in December 2021.
So it's making a comeback, likely facing more legal fights.
Almost certainly. Given that history, you can expect renewed legal challenges from the big pharmaceutical companies. Their main argument is usually that these kinds of price controls stifle innovation, R&D investment, that sort of thing.
Understandable argument from their side. So what's the potential impact on Indian pharmaceutical companies? They're huge generic suppliers globally.
Well, the report's analysis at this stage suggests that Indian generic companies are likely not the primary target of this initial policy push.
Why is that?
Because the current proposal seems focused on benchmarking U.S. prices against those in other developed countries. However, and this is a crucial but, if the U.S. were to broaden that MFN designation down the line to include India or other emerging markets, then the impact on Indian pharma could be quite different, potentially quite significant.
Ah, okay. So for now, no immediate earnings hit expected, but keep a close eye on it.
That's the conclusion for now, yes.
Yeah.
No immediate earnings impact anticipated, but strong advice to monitor the situation very closely as it evolves. Anything could change.
Right. So taking a step back then, looking at the overall market outlook, considering all these different threads, The report mentioned volatility was high but has eased recently.
Yes, volatility spiked over the past 6 weeks or so, largely driven by all this tariff news.
Mm.
It has shown some signs of easing lately.
But the underlying risks, they're still there.
Oh, definitely. Things like global economic fragmentation, ongoing policy uncertainty, those trade barriers that are still quite high, those fundamental risks haven't just vanished.
And the market seems to be shifting focus.
Yeah, the report observes a shift away from purely sentiment-driven moves towards more focus on underlying economic fundamentals, which suggests we might be entering a period of market consolidation, sort of catching its breath.
Okay. And what about company earnings? The near term looks a bit, yeah.
Meh is probably a fair description. The expectation is for pretty muted earnings for Q4 of fiscal 25, maybe mid-single-digit growth. Overall, fiscal 25 is looking, well, underwhelming.
But there's hope for fiscal 26.
There is. The consensus forecast for FY26 points to more robust earnings growth, maybe around 13%. And there are some early signs that the economic slowdown might be starting to bottom out.
But a slow recovery, not a sharp bounce.
Expected to be gradual, yes. Not a V-shaped recovery.
So for investors, it's less about riding broad market waves right now, more about...
It's much more about being selective. The current dynamics really favor a bottom-up approach. You need to dig into the specifics of individual companies, their fundamentals, their prospects, rather than just betting on whole sectors.
A more nuanced company-specific strategy, then.
Precisely. Although, despite all these near-term headwinds and uncertainties we've talked about, the report does maintain a positive long-term outlook for the Indian economy specifically.
And the advice for navigating these choppy waters, is it still diversification?
Absolutely. That remains key. Maintaining a well-diversified strategy, spreading investments across different market caps, different sectors, is always prudent, but especially when there's so much global uncertainty.
Maybe hybrid funds offer a balance.
The report suggests hybrid funds could be a reasonable option in this environment, yes.
Yeah.
Balancing potential returns with managing that downside risk.
Okay. So to kind of bring it all together, this deep dive into the changing world of global trade and tariffs report really just hammers home how interconnected everything is.
It really does.
We've looked at the immediate market hits, the potential longer-term effects on sectors from tariffs, trade deals, even these farmer pricing plans.
Yeah, the ripple effects are wide.
It really makes it clear that understanding these shifts is, well, vital, whether you're running a business, managing investments, or frankly, just trying to stay informed about the global economy.
And if you connect it all, the bigger picture that emerges is this constant reevaluation, this strategic repositioning happening everywhere. These aren't just isolated incidents.
No, they're all part of a larger reshaping of how global commerce works.
Exactly. Reshaping economic relationships.
It really makes you wonder, with all these ongoing talks, the U.S.-China situation still fluid, new deals like India-UK, policy changes like the drug pricing, what's going to be the most unexpected consequence for just, everyday consumers around the world in the next year or so?
That's a great question. Unexpected consequences are almost guaranteed in this environment.
Definitely something to keep thinking about.